Well, I think you're right. I think that tomorrow, we're in like the last part of August, which is very a quiet time in the market. And this is when the Federal Reserve has a symposium in Jackson Hole every year. This time it'll be virtual. And because the Federal Reserve is seen to be at some crossroads, Chairman Powell's speech is going to be closely monitored. Many people are looking for hints about formally changing how we interpret the inflation target. Right now, as you know, it's 2% on the PCE, the personal consumption expenditure deflator. And so in past cycles, as we approach that 2% level, the Federal Reserve begins taking away the punch bowl. It begins tightening policy. But instead, what people expect the Federal Reserve to signal is an average inflation target, which means that because we've undershot inflation for a while, now we can overshoot it. And so I think that's what people mean when they think that the Federal Reserve will tolerate higher inflation. I sort of wonder about this because, the Federal Reserve has not reached its target since 2012. And so what are they in fact telling us when they say that they'll tolerate higher inflation? They're really claiming something that they don't have the credibility yet to really strive for. That is to say, up until now, they say we're trying to get 2% inflation, but now what they're going to tell us is now we're really serious about it. And I think that it doesn't really mean that much to the market until it really sees higher general price levels. And I think that right now we're still. I know as like someone who spends money on groceries, pays health insurance, I know that many Americans are seeing higher prices, but what it means, though, when we talk about inflation, is not like if the price of beef goes up, some people will substitute beef and buy more chicken. Or if the price of butter goes up. And so what the Federal Reserve is most concerned about is a general increase in prices, not just relative price increases. And because of that, I think that the Federal Reserve still thinks that price pressures are low enough to allow both the federal government as well as the central bank to provide more support for the economy. The Federal Reserve, I think, would adopt an average inflation target, not so much because it's concerned about inflation today, but two things. One is it's finishing up like a year-long review of its policies and its tools. And secondly, I think that I would file this under forward guidance. What the Federal Reserve wants to do is to convince businesses and investors that they're not going to raise interest rates anytime soon. And by indicating that, that's going to help keep interest rates low. And so I think what the Federal Reserve says then in effect is, don't worry, even if inflation approaches 2%, we're not going to raise interest rates. I think that gold is elevated prices. We got above $2,000 an ounce, but in the past week or two, we've really been consolidating, for the most part, below $2,000. But I think you're right that there's several factors that have helped drive the price of gold up. Some people are worried that inflation is going to be the ultimate result. But on the other hand, there's other reasons why some people might be buying gold. For example, some short-term traders, momentum traders, they see a market that's been one of the strongest markets in the world, has been gold this year. And so they want to participate in it. So that brings in, and most of our economics understanding, the higher price of something should reduce its demand. But in the case of gold, like other instruments from time to time, the higher price has brought in new buyers. Goldman Sachs had a report out a week or two ago that suggested that the strength of gold wasn't so much about inflation, but worries about the long-term future of the U.S. dollar. And I think that I think there's a lot of reasons why people have been bullish gold. Also remember that there's something like $15 trillion of negative yielding bonds. All these factors, I think, conspire to help lift gold prices. I think that sentiment towards the dollar is just on the verge of shifting back more in its favor for the short run. And why do I say that? Partly because we've been surprised by the strength of the U.S. PMI, Purchasing Managers data. Europe disappointed. We've been getting a series of stronger than expected U.S. economic data, prompting people to revise up Q3 GDP forecasts. In addition, it looks like the COVID cases are on decline, a slowing pace of growth in the U.S., while they are on the rise in Europe. And so I'd say August has been really about broad trading range for the dollar, and I think that we're still prone to have a correction. I think you're right about what China's been doing. It looks like it has stepped up its purchases of corn, soybeans, and we're not going to see this in the numbers until next month. But there's something like 9 tankers full of oil from the United States, almost 37 million barrels that are believed to be headed towards China as it tries to fulfill its commitments under the Phase 1 trade agreement. I think that the tensions between the U.S. and China aren't about trade right now. That'd be one area that things are going fairly well. Just today, the U.S. sanctioned more Chinese officials, more Chinese companies, and I think that in the South China Sea, there might have been U.S. is trying to demonstrate the freedom of navigation, and there might be like little skirmishes, like dogs trying to demonstrate both the U.S. and China, both trying to demonstrate their claims. And so I think that there's a lot of different areas in which the U.S. and China have tensions, but trade, ironically, is not one of them. So, a year ago, the U.S. cited China as a currency manipulator for the dollar going above 7.0 against the renminbi. Today, the dollar is at 7-month lows against the RMB. And to me, that suggests that Chinese officials have succeeded in decoupling the trade tensions, or tensions in the overall relationship, from the exchange rate. How close you look at the U.S. stock market. From a distance, you'd see the S&P, the NASDAQ at record highs. And you say, well, this is really good. A lot of U.S. companies are rallying, are really strengthening. But instead, what you find is that 5 companies in the S&P 500 are up this year by about 35% on average. The other 495 companies are down on average. And so what we really have in the U.S. is a very thin breadth to the market. The FANGs are really leading this. High-tech companies that are arguably going to benefit during this period where people are locked in at home and have little social contact. So the internet, things that service the internet, seem to be the big winners.